Hello and welcome to this daily market commentary for the 27th of January 2020. A new week sees an old theme dominate. If President Trump had hoped there would be something to detract from his impeachment trial, he got it in the form of the coronavirus. We seem to be talking about it every day, and I imagine we will be for some days to come. While the Chinese community attempt to celebrate the Lunar New Year, 81 people have so far died and almost 3,000 are confirmed ill. Almost 50 cases have been confirmed outside of China, although thus far, no deaths. In Shanghai, the holiday has been extended to the 10th of February to keep businesses closed. All of this will have an effect on the Chinese economy and potentially the global economy, thus the sharp risk aversion in the markets. Monday would start with moves lower for equity markets and traditional risk-on FX pairs, such as dollar yen and yen crosses, as well as Aussie, Kiwi, and Canada. Gold will continue to benefit as oil prices move lower. As the US dollar gets going, dollar yen dropped to a low of 108.73 and euro yen down to 119.92. Euro US would drop to 110.11 and sterling against the US down to 130.41. Aussie, Kiwi, and Canada would weaken to 0.6752, 0.6544, and 131.99 respectively. Stocks in Asia would move lower, led by the Nikkei down 2%. All the major European bourses would also fall sharply. The DAX down 2.7% on the day, and the UK FTSE 100 down 2.3%. In the US, things were marginally better, but the Dow Jones and the S&P closed lower by nearly 1.6%, taking the Dow Jones into negative territory for the year. Question is, has the stock market reversal begun, or is this just a blip on the radar as the world gets to grip with the coronavirus? Going forward, all eyes will be on yen crosses and equities if the situation worsens. For today, the moves were sharp and some would say predictable, but volatility is on the rise and the markets will react to every headline, positive or negative, going forward. I recently commented in a technical piece about the Russell 2000, and I'm going to look at that one again today. Really just to prove a point as nothing else. When I decommented it originally, I said it was underperforming the other three major US indices. And you can see from this chart, we have the Russell 2000. This is a daily chart in red and green, and then over the top of that, I have the S&P 500 in orange. Now, if we go back here to September and early October 2018, we can see the Russell 2000 has made a high just above 1740, and we see the S&P at the time have made a high around about 2930, and then we obviously had a fairly sharp retracement towards the end of 2019, and then we had to bounce back up. The point I was making at the time was that whilst the Dow Jones, the S&P, and the Nasdaq have all reclaimed those September and October highs of 2018, the Russell 2000, in fact, had not, and was still lagging. It's still not quite reached the 1740 level around that time. So the point being here, being the one that hasn't made a new high, it's one to keep an eye on. And as we can see here, obviously the coronavirus situation has had a detrimental effect on stock markets. And we can see here in red and green that we now have the Russell 2000 is almost leading the move lower, with the S&P kind of following, if you like. So, my take on that is, going forward, if we are going to get a correction, or even if you get a little bit of reversal of today's moves, keep a very close eye on this correlation and the price action of the Russell 2000, because it might give us a bit of a broader clue as to where the other stock markets are going, and with that potentially some of the FX pairs as well. And with that, I hope everyone had a good day and caught some of the moves, and I look forward to speaking with you tomorrow. Cheers.